Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Okay, let's dive into this week's major market moves.
So, the big story this week is a huge decision from the US Federal Reserve, and it's basically sending global economies down completely different paths. Here's how we're going to break it all down. First, we'll get into the Fed's big dovish pivot and the tricky balancing act that led to it. Then we'll see how Wall Street reacted. Spoiler alert, it was explosive. After that, we'll zoom out and look at the bigger picture, how central banks everywhere are now charting their own course. We'll tell you what to look out for next, and we'll wrap it all up with the big question. What does this great divergence really mean for this market rally?
Okay, let's get right to the main event. The single biggest story of the week, no question, was the massive shift in policy coming out of the Federal Reserve.
That's right. For the first time in over a year, the Fed actually cut its benchmark interest rate. They announced a quarter-point or 25 basis point reduction, bringing the new target range for the federal funds rate down to between 4 and 4.25%. And this isn't just a minor adjustment. This is a huge signal that we're heading in a new direction.
And this isn't just a rumor. This is straight from the source. The official statement from the FOMC on September 17th made it crystal clear. This move officially slams the door on that long period of just holding rates steady, and it really feels like it's kicking off a whole new cycle of easing. But that just makes us ask the obvious question, why now?
So yeah, why the sudden move? Well, it turns out the Fed's decision wasn't as simple as it looks. You could say they're walking a tightrope, trying to balance two very different and very serious risks.
And this slide really gets to the heart of the Fed's problem. On one hand, you have the labor market, which is clearly cooling off. Payroll gains have slowed to a crawl, averaging just 29,000 a month. Unemployment has ticked up to 4.3%. Even Fed Chair Powell said it himself. The downside risks to jobs have gone up. But on the other hand, inflation just won't go away. The PCE number for August, which is the one the Fed watches closest, is still at 2.7%, and core inflation is even higher at 2.9%. Both are still well above that 2% target.
And this chart really paints the picture, doesn't it? I mean, look at the sharp slowdown over the last 3 months. With the job market losing steam this fast, the Fed decided to make what Chair Powell called a risk management cut. Think of it as an insurance policy. They're trying to prevent a really bad economic downturn, even if it means they have to live with higher inflation for just a little while longer.
So, the Fed takes out this insurance policy. And how did the markets react? Well, with absolute euphoria. Wall Street saw this move as a giant green light to just go for it and take on more risk.
The reaction was immediate and it was powerful. The S&P 500 just surged, blasting right past its old peak and closing at a new all-time record high.
Of course, the tech-heavy NASDAQ was not about to be left out of the party. It also rocketed to its own new record as investors just piled into those growth stocks.
And to complete the trifecta, the Dow Jones Industrial Average joined right in, making it a clean sweep for all three major US indices. The logic was simple. Lower borrowing costs should fuel more growth.
The news headlines captured the mood perfectly. We saw phrases like Wall Street Nirvana and comparisons to that huge risk-on rally we saw back in 2021. For the US markets, this was pretty much the best news they could have asked for. But what about the rest of the world?
And this is where the story gets really, really interesting. Because while the US is celebrating, the global picture is way more complicated. The Fed's decision has really put a spotlight on this huge divergence among the world's major central banks.
I mean, just look at this table. You've got the US cutting rates with inflation still at 2.7%. At the same time, the UK is holding firm with even higher inflation, while Canada is cutting rates for completely different reasons. It seems like every central bank is playing its own game right now, which has massive implications for currencies, especially pairs like the eurodollar and the dollar-yen. Let's break it down one by one.
First up, Canada. They also cut rates, bringing their policy rate down to 2.5%, but their reason was a lot more clear-cut than the Fed's. Canada's economy is showing some real signs of weakness. We're talking about GDP actually shrinking and the unemployment rate climbing up over 7%. For them, this rate cut was less about risk management and more about necessity.
Now, let's hop across the Atlantic to the Bank of England. They're in a completely different boat.
They chose to hold their rates steady at 4%. And why? Because they're stuck between a rock and a hard place. Inflation is still really high at 3.8%, but economic growth is pretty weak. So they're just holding on, opting for a wait-and-see approach.
The European Central Bank has yet another unique situation. Believe it or not, inflation in the euro area is right on their 2% target, a level the Fed would probably be pretty jealous of right now. With prices stable, the ECB feels no real pressure to do anything, so they're holding steady while they keep an eye on sluggish growth. And this gap, the Fed cutting while the ECB holds, is a huge driver for the USD exchange rate.
And then we have the true outlier, Japan. For decades, the Bank of Japan was desperately trying to create inflation. Well, they finally got their wish. Their core inflation is now running at 3.3%. So their challenge is the mirror image of everyone else's. How do you manage a return to inflation? This massive policy difference is exactly what makes the USD-JPY pair so fascinating to watch. Okay, so with all these different economies on different tracks, what should we be watching for to see where we go from here? Well, the economic calendar is absolutely packed with crucial data points.
Looking at what's coming up, as seen on the Investing.com economic calendar, we've got several key reports. We'll be watching the euro area's inflation data to see if their price stability is holding up. The UK's next labor report will be critical for the Bank of England. And of course, here in the US, all eyes will be on the next non-farm payrolls report. That'll tell us if the job market weakness that prompted this Fed cut is getting worse or if it's stabilizing.
Which brings us right back to our main theme, the Great Divergence. What we have is a situation where the US market is rallying like crazy based on a policy change, while the rest of the world is dealing with very different and often difficult economic realities.
And that leads us to the final big question we want to leave everyone with. The Fed has lit a fire under US stocks, and there's a real sense of optimism. But can a rally in just one major economy keep going when its biggest trading partners are slowing down, holding steady, or fighting completely different economic battles? This tension between the euphoria in US markets and a fractured global outlook is the story we'll all be tracking in the weeks and months ahead.
Thanks for watching. Don't forget to like and subscribe.